Hello, I'm Haida Malik, host of the Mehmi Financial Group podcast. Today's topic is winning big contracts using equipment financing to take on larger projects. Securing larger jobs often means having the right machines at the right time, but purchasing high value equipment outright can tie up capital. In this episode, we'll discuss how creative financing lets you expand capacity, bid on bigger contracts, and strengthen your balance sheet. First, identify the equipment requirements of your target projects. Big ticket contracts like highway builds, large commercial developments, or municipal infrastructure often demand specialized machinery. Tunneling drills, heavy cranes, concrete pavers, or high capacity loaders. Map out which assets you need, how long you'll use them, and what cash flow those projects will generate. This analysis forms the backbone of your financing pitch. Next, explore term loans structured around project revenue. Many banks and equipment financiers offer project backed loans that match repayment to contract milestones. Instead of a fixed 7-year term, you can negotiate a 5-year amortization aligned with project cash draws. Present projected payment schedules and retainage release dates to demonstrate repayment capacity. Lenders appreciate visibility into client payment terms. This often translates into higher advance rates and lower spreads. Equipment leasing is another powerful lever. With a finance lease, you secure the machine for the project duration with a small buyout at term end. Lease payments are often tax deductible and preserve working capital for mobilization costs, labor, and materials. For very large machines, consider an operating lease or rental agreement that lets you return the equipment when the job finishes without a lump sum buyout. This flexibility prevents you from being stuck with idle assets when the contract wraps up. Sale-leasebacks can inject liquidity if you already own complementary machinery. Selling owned units to a financier and leasing them back frees up capital to acquire the specialized equipment for the new project. The predictable lease payments can be structured to coincide with project progress draws, keeping cash flow in sync with expenses. Revolving lines of credit secured by current receivables or chassis inventory offer another layer of flexibility. As you bill progress payments or mobilization fees, you can draw against outstanding invoices up to 80%, smoothing gaps between project invoices and payroll. Lenders often provide accordion features that let you increase your facility as project scope grows. Invoice factoring may be worth considering if contracts require 30 to 90-day payment terms. By converting receivables into immediate cash, you avoid tapping lines of credit and maintain better interest rates. Choose a factor with construction expertise, one that understands retainage rules and can handle project billing complexities. Vendor financing and OEM partnerships also come into play. Manufacturers sometimes support customers pursuing large infrastructure contracts by offering preferential finance terms, deferred payments, or extended warranties. Leverage your project win letters to negotiate promotional rates or flexible payment schedules directly with equipment dealers. Government and quasi-government programs can further reduce your cost of capital. Programs like the Canada Infrastructure Bank's co-investment funds or provincial economic development loans often back equipment purchases for public works. These funds help de-risk lenders' exposure and can translate into rate discounts of 0.5 to 1%. Before locking in any structure, run a total cost comparison. Include interest, lease fees, maintenance expenses, residual value risk, tax benefits, and any required insurance or standby letters of credit. Model cash flow under different payment delay scenarios, permits, weather interruptions, or supply chain shifts to ensure your financing plan remains resilient. 3 steps to implement this strategy. 1. Document your project's billing schedule, anticipated payment dates, and retainage release terms. 2. Assemble a financing package including financial statements, project contracts, equipment specs, and your project cash flow model and share it with brokers and lenders. 3. Solicit multiple offers for term loans, leases, lines of credit, and vendor financing. Then compare on true cost of capital and alignment with project milestones. Using equipment financing to support larger contracts not only preserves your working capital but also lets you seize growth opportunities without overextending. By matching financing structures to project cash flows, you'll bid more competitively, deliver on time, and build a reputation capable of winning even bigger jobs in the future. I'm Haider Malik. Thanks for listening.